Where does the money go when the market crashes? The number on the screen means nothing yet. That's the part no one tells you when the red starts spreading across the board. The portfolio value dropping in real time, the notifications stacking, the financial media cycling through the same breathless vocabulary, crash, collapse, wipeout, all of it designed to make you feel like something is being destroyed. Like wealth is evaporating into the air the same way a building burns down, leaving nothing but ash where something solid used to stand. But that's not what's happening. When a market crashes, the money doesn't disappear. It doesn't cease to exist. It doesn't get swallowed by some systemic void that opens up beneath the trading floor. The capital that existed before the sell-off exists after it. What changes is where it sits, who holds it, and what it's now worth to the people holding it. And this distinction between the feeling of destruction and the reality of redistribution is one of the most consequential things a serious investor can understand. Not because it makes crashes comfortable, they aren't, but because it reframes what a crash actually is. Not an ending, but a transfer. Not a fire, but a migration. The question worth asking, and the one that determines whether you're on the receiving end or the losing end of that transfer, isn't whether the market is falling. It's where the money is going. Every trade that executes in a market requires two parties, a buyer and a seller. This is not a technicality, it is the foundational architecture of how price is determined in any liquid market, and it is the first thing to understand when a crash begins to accelerate. The stock market is not a storage facility. It is not a place where wealth sits in numbered compartments waiting to be retrieved. It is an auction, continuous, real-time, and entirely dependent on the collective perception of value at any given moment. When you buy a share of a company, you are not purchasing a fixed quantity of stored wealth. You are purchasing a claim on future value, priced by what the last willing buyer and seller agreed to exchange it for. This matters enormously when panic enters the system. When markets fall sharply, what is actually happening is that the perceived value of assets is being revised downward, rapidly, and often indiscriminately. Sellers are accepting lower prices. Buyers are demanding them. The auction continues, but the bids are coming in lower with every passing hour. The result looks from the outside like destruction. Trillions of dollars in market capitalization gone in a matter of days or weeks. But market capitalization is not the same as money. It is a calculation, share price multiplied by shares outstanding. When the share price falls, the calculation changes. The money that was used to purchase those shares at higher prices did not vanish. It changed hands at the moment of each prior transaction, and it now sits somewhere else in the system. The market didn't destroy the capital. It repriced the assets. That distinction is where most retail investors lose the thread, and where patient capital begins to see opportunity. There is a specific moment in every market crash where the damage stops being theoretical and starts being real. It is not when the index drops 10%. It is not when the headlines turn apocalyptic. It is not even when the portfolio statement arrives showing a number significantly lower than the one from 3 months prior. The damage becomes real the moment you sell. This is what separates a paper loss from an actual loss. And the distinction carries more strategic weight than most investors are willing to sit with when markets are falling. As long as you hold the asset, the lower price is a number on a screen. It reflects current market sentiment, current fear, current liquidity conditions. It does not reflect a permanent verdict on the value of what you hold. Markets have consistently demonstrated the capacity to reprice assets upward once panic subsides and fundamentals reassert themselves. The investor who sells into a crash locks in the loss. The number stops being theoretical and becomes fixed. The capital that remains after the sale is now smaller, and the investor is no longer positioned to participate in the recovery that historically follows periods of maximum dislocation. This is not an argument for holding everything indefinitely, regardless of circumstance. Fundamentals matter. Position sizing matters. The quality of the underlying asset matters. But the mechanical reality is straightforward. Selling during peak panic converts a temporary pricing event into a permanent capital outcome. The market does not care about your cost basis. It does not register your anxiety. It continues its auction, repricing assets based on the aggregate behavior of every participant in the system. And while one investor is selling to reduce the pain of watching the number fall, another investor, with longer time horizon, stronger conviction, or simply better liquidity, is on the other side of that trade. Which brings the analysis to what crashes actually produce at the structural level. Every share that is sold during a crash is purchased by someone else. This is not a philosophical observation, it is a mechanical certainty. For every seller accepting a lower price in a moment of panic or forced liquidation, there is a buyer on the other side of that transaction who has made a different calculation, that the asset is worth more than the current price reflects, and that the spread between present fear and future value represents an opportunity worth taking. This is how wealth transfers during a market crash, not through destruction, but through redistribution. Capital moves from hands that could not or would not hold through the volatility, into hands that were positioned, financially and psychologically, to absorb it. The mechanism is not complicated, but its consequences are significant. The investor who sells a diversified equity position at the bottom of a crash cycle does not simply lose the paper value that evaporated during the decline. They transfer the actual shares at the claims on future earnings, dividends, and appreciation to whoever was willing to buy them at distressed prices. The subsequent recovery, when it comes, accrues entirely to the new holder. History has demonstrated this pattern with enough consistency that it should register as structural rather than anecdotal. The 2008 financial crisis produced one of the most severe wealth transfers of the modern era. Investors who liquidated positions at the depth of that cycle, some out of genuine financial necessity, the others out of panic, handed their equity stakes to institutional buyers and patient private capital that recognized the dislocation for what it was. The bull market that followed ran for more than a decade. The wealth did not disappear in 2008. It moved. And the direction it moved was away from those who could not hold, toward those who understood that the crash was not an ending. It was a repricing event that created the entry conditions for the next cycle of accumulation. When serious capital exits equities during a crash, it does not cease to function. It relocates. This is what market participants refer to as capital rotation, the movement of institutional and retail money out of risk assets and into positions that offer either capital preservation, yield, or a combination of both. Understanding where that capital flows during a crisis is not a secondary concern. It is central to understanding the full architecture of what a market crash produces at the macro level. The most immediate destination is cash. Liquidity becomes the priority when volatility spikes, and the cost of being wrong in a leveraged or concentrated position becomes existential. Holding cash during a crash is not a passive decision. It is an active repositioning toward optionality. Yet capital in cash is capital that can be deployed when the dislocation reaches its maximum point, and the risk-reward calculation shifts. Government bonds represent the second major destination. In environments of acute financial stress, sovereign debt, particularly short-duration instruments, absorbs significant flows from investors seeking stability. This dynamic compresses yields and reinforces the safe haven premium that government paper commands during crisis periods. But here is what most investors are missing when they watch capital rotate out of equities and into these conventional havens. A portion of that capital, historically significant and increasingly relevant in the current macro environment, moves into tangible assets. Gold has functioned as the most institutionally recognized store of value during periods of monetary stress and market dislocation. Its role is not speculative in these moments. It is structural. It absorbs capital that is seeking preservation outside of the financial system's paper architecture. This rotation is not random. It reflects a rational reassessment of risk at the institutional level. A recognition that when the auction floor becomes unstable, the assets that hold value independent of counterparty confidence become strategically essential. The money leaving equities is not disappearing into the sidelines indefinitely. It is waiting, repositioning. and the assets it moves into during that waiting period tell a precise story about where institutional conviction actually resides when the system comes under pressure. Not all selling during a crash is voluntary. This is a critical distinction, one that explains why market downturns can accelerate with a velocity that seems disproportionate to the underlying catalyst. When prices begin to fall sharply, a secondary mechanism activates inside the financial system that has nothing to do with investor sentiment or fundamental reassessment. It is purely mechanical, and it is one of the primary forces that converts an orderly correction into a disorderly crash. Margin calls. When institutional players, leverage funds, and retail traders borrow against their positions to amplify returns, they do so within a framework of collateral requirements. As long as the value of the underlying assets remains above a certain threshold, the leverage holds. But when prices fall far enough and fast enough, the lender demands additional collateral or immediate liquidation of the position to cover the exposure. The investor does not get to choose the timing. The sell order is triggered by the structure of the leverage itself. This forced selling creates a compounding dynamic that is distinct from panic selling in one important respect. It is indiscriminate. Assets are liquidated not because they have been fundamentally reassessed, but because they are available and liquid and the margin requirement must be met. Quality positions get sold alongside deteriorating ones. The price of everything in the portfolio becomes subject to the liquidity needs of the leverage structure. And this is where the cascade effect originates. Forced selling drives prices lower. Lower prices trigger additional margin calls across other leveraged positions. Those margin calls produce more forced selling. The loop tightens with each iteration, and the speed of the decline accelerates in ways that appear, from the outside, to be driven purely by fear, when in reality, much of the mechanical selling pressure is being generated by the architecture of leverage itself unwinding under stress. The institutions and funds caught in this dynamic are not making strategic decisions. They are responding to structural compulsion, and on the other side of every one of those forced liquidations is a buyer who was not leveraged, did not face a margin call, and is now acquiring assets at prices that the seller had no power to negotiate. Liquidity in these moments is not just a financial condition. It is a form of structural advantage, one that determines which side of the forced transaction you occupy when the cascade reaches its maximum intensity. The strategic implication of everything examined so far is not complicated, but it requires a level of analytical clarity that becomes increasingly difficult to maintain as volatility rises and the financial media environment reaches peak saturation. Crashes are not symmetric events, or they do not distribute their consequences evenly across all market participants. The outcomes, who loses capital permanently, who transfers it, who accumulates it, are determined almost entirely by two variables: liquidity and conviction. The investor who enters a period of market stress with strong liquidity and a well-reasoned thesis about the assets they hold occupies a fundamentally different position than the investor who is leveraged, concentrated on, or psychologically unprepared for sustained volatility. This is the core of what patient capital means in practice. It is not passivity. It is not indifference to price action. It is the structural capacity to remain on the correct side of the wealth transfer that every significant market dislocation produces. The risk asymmetry during a crash favors the unleveraged, liquid, conviction-driven investor in a specific and measurable way. A downside is capped by position size and the quality of the underlying asset. Upside is determined by the spread between the distressed entry price and the recovery valuation, a spread that historically widens the more severe the initial dislocation. The deeper the crash, the larger the transfer. The larger the transfer, the more significant the eventual reversion to fundamental value for those positioned to hold through it. This is not an argument for recklessness or for ignoring genuine deterioration in asset fundamentals. Crashes sometimes reflect real structural problems that require genuine reassessment. The 2008 crisis exposed leverage and counterparty risk embedded in the financial system that demanded a fundamental repricing of certain asset classes. Patient capital does not mean holding assets through permanent impairment without adjustment, but it does mean understanding that the majority of selling pressure during a crash is not driven by fundamental reassessment. It is driven by panic, leverage, and forced liquidation, three forces that create temporary price dislocations that are systematically disconnected from long-term value. And it means recognizing that those dislocations are not threats to the patient investor. They are the mechanism through which the patient investor accumulates. The strategic holding thesis is ultimately a thesis about time horizon and structural positioning. The investor with the longer horizon and the cleaner balance sheet absorbs assets from the investor with the shorter horizon and the over-leveraged position. This is not a market anomaly. It is the market functioning exactly as designed, rewarding those who understand its architecture over those who are subject to it. What a market crash ultimately reveals is not the fragility of wealth. It reveals the fragility of the assumptions underneath it. The investor who believed their portfolio value was a fixed and reliable number discovers that it was always a price, contingent, negotiated, and subject to the collective behavior of every other participant in the system. The investor who understood this going in is not surprised by the crash. They were positioned for it. Not in the sense of having predicted the timing or the magnitude, but in the sense of having built a financial posture that does not require the market to behave rationally in the short term in order to produce a rational outcome over time. This is the psychological dimension that separates capital that compounds from capital that erodes. It is not intelligence. It is not access to better information. It is the capacity to hold a reasoned thesis under conditions specifically designed. By volatility, by media pressure, by the visible pain of declining numbers, to make abandoning that thesis feel like the only sensible option. The money does not disappear when markets crash. It moves toward those who understood, before the crash began, that this is how the system works. The question that remains, and it is worth sitting with rather than resolving too quickly, is whether the next major dislocation will follow the same redistribution pattern as those that preceded it, or whether the scale of leverage, the concentration of institutional positioning, and the macro pressures currently embedded in the system will produce a transfer of a different magnitude entirely. That answer is not yet visible, but the structure of the question should inform every positioning decision being made right now.